Welcome to the What to Watch video update. I hope everybody's enjoying a nice Labor Day weekend. This is the last video that I do, and I take all the charts that seem to be telling us something right now, and I put them into three categories. Of course, there's some dispute because some of these that are positive, you could say are negative. Some of the areas that I'm watching look either positive or negative, but I do break them down into three basic categories: positive, negative, and then those things that we're keeping an eye on. We're asking the question this week, can the S&P 500 reclaim 6,500? Now we got above that on Thursday and we set an all-time high. We closed above a level we've never been at before, and then we went down on Friday. Now, Monday and Friday last week were not all that great. Tuesday, Thursday through Thursday, that was looking pretty good. But we continue to be below average with volume. Now that Labor Day is coming and going, is volume going to pick up? Is the smart money going to come back in and do buying, or are they going to start to do some selling? September historically is not a very positive month, whether you look over the last few years or even going back to 1950 or so. Now, August is supposed to be negative as well, and we were up almost 2% for the month of August. So we broke that precedent in a post-election year. We've never had a positive August before. We'll see. Is September going to be any different? Now, the market is really hoping that the Fed's going to come in and cut rates. That's what they're anticipating when they meet in a few weeks. We did get a read on GDP this past week, and it was kind of the best of both worlds, where GDP was revised up in the second reading, but inflation stayed the same. I guess it could have gone down. That would have been even better. But the market already knew that. We already saw this number before, and then when it comes in the second time and looks even better, the market likes that. We're going to get the employment situation report on Friday in the upcoming week, and that's very important as well. So far, the employment area has been holding up quite well, and that has been justification for the Fed to keep rates higher for longer. Well, they're starting to come out and say, well, we might be open to the idea of coming in and cutting rates. We're not only hearing it from Jerome Powell a week ago at Jackson Hole, but other members of the FOMC. They seem to be more inclined. They're more dovish in that area. So there are some positive things, but at the same time, we're seeing a little bit of defensive buildup, shorter term. Bigger picture, we're looking good for right now, but shorter term, we're seeing some things that are causing some concerns. And this is being prepared for Tuesday, September 2nd. Okay, so the positive side, we've been going up even though we went down on Friday, but this chart is still looking good, positive overall. We came in and got above this pivot point. These were pivot points for July as well as August. We got a little bit above that. We're coming back down. We're just a little bit above the pivot point currently. So is this support that's holding? Now, usually what happens, the support that was just made, sometimes this varies for an intraday chart, but usually some time has to pass before it's considered to be more of a valid support level. So we're wondering, has enough time passed? Are we going to be able to find support at this pivot now and then go back up? Now we do have new pivot points for September. And as I pointed out in the daily video, we're starting off with a positive slant here. The pivot point, if you pivot above, that's considered positive. If you pivot below, that's negative. We're starting off with the first trading day, unless we really gap down right at the open. We're starting off looking more positive here on the daily chart. We're above the daily pivot, and that will last for the entire month of September. Now, we have been seeing volume really dropping off, well below the moving average here, and even the moving average is going down slightly. The anticipation is that volume will pick back up after Labor Day, and school is back in session. Folks are done with their vacations, and we might see an increase in volume. Now, you never know what's really going to happen, but that is the anticipation. Okay, now, even though we were down in Friday's session, for the most part, we've been looking okay here as far as the fear and greed index, unless it gets to an extreme reading, around 75 or down below 25. That's when we use it as a contrarian indicator. When it's moving one way or the other, we tend to go with that. And we've had some bumps along the way here. But for the most part, this has been going up and sentiment has been improving, and that is seen as positive. And we're looking okay here with the advanced decline line for the S&P. We actually went up a little bit in Friday's session, even though it was a down day. And we did decline a little bit here based on volume. But bigger picture, this is still looking positive. We're above advancing moving averages. Also, trailing off a little bit with the new highs, but not really seeing any new lows. That's causing the 5-period moving average to roll over a bit here, but we're still going up with the 10-period. So internally, things are looking positive within the S&P. We're also above zero and going up with the advanced decline oscillator. This goes over the last 10 periods, and we use it like an oscillator, looking for extreme or positive or negative readings. And above zero is considered to be positive. Not showing an awful lot of conviction here through July and August. We kind of go above zero, then below zero. We'll see if there's a little bit more conviction that comes in. But for right now, this is more positive since it's above zero and going up. Now, this is a bit of a mixed picture here. Accumulation distribution did come down a bit in Friday's session, but we're still above the advancing moving average. This is smart money indicator number one. Short term, though, this is a modified MACD. We are rolling over. So short term, we're looking a little bit more negative. Longer term, we're still looking positive. And we look at the short-term trend now. We were starting to cross above the moving average here with the ADX, but then we had the down day on Friday and we came back down below the moving average. So that's still a weakening trend, but it's positive. Even though the green line came down and the red line came up, the green line is still above the red line. Short-term is positive. Intermediate term, we're still below the moving average, but the green line is still above the red line. That's still a weakening trend, and we're not trending currently with the weekly chart. We're down below 20 with the ADX. We're still continuing to decline below the moving average, but we're still positive with the green line above the red line. So all three time frames are positive, just not showing a lot of conviction currently. Then we want to keep an eye on the 20-period simple and exponential moving averages. We're above them, and we've been above them ever since we broke out to the upside with the S&P after that mess that we went through in April. We did get down below it, and that was when the employment report came out for August. Now we're going to get some kind of a hit or surprise that the market's not going to like this coming Friday. Is there going to be some selling in anticipation of that? We don't know. We'll just watch things as they unfold. But for right now, we're above the moving average and we're going up with both moving averages. So the short-term trend is positive. All right, and we look at all the different moving averages, not just the 20, but then the 50, 100, and 200s. And all of those are still going up. That is positive. We're positive with the parabolic SAR daily chart. The weekly chart is also positive. And we look at smart money indicator number two. I should have had this up next to accumulation distribution, but even with the down day, we're going up with the Chaikin Money Flow, and the red line is going up. So that is positive. And we came down a little bit with the Chaikin oscillator. This is smart money indicator number three, but we're still above the moving average. It's not considered negative until we drop below this hard to see moving average that is here on the chart. So for the time being, it's still positive. And we are coming down a bit with the green line, up with the red line, but the green line's still above the red line with the vortex. That is still positive. So you can see a little bit of weakness kind of coming in here. We came up a little bit with the VIX, but we're still below the moving averages based on the line here. That's the closing value. And we're also even below the moving averages with the bar chart as well. Okay, and this is actually looking okay, even though it took a bit of a hit on Friday. We're seeing discretionary doing quite well right now. It's staples, which are more defensive, they've actually been declining. That's helping the discretionary to staples ratio go up. And I've said this in every video, and I'll keep saying it. It was about a year ago, it was August of 2024, when we had that scare out of Japan. The VIX went up to 65. Everybody was freaking out. They were demanding 1.5% rate cuts immediately by the Fed, and then another one at the upcoming meeting. Well, that end of the world day just lasted a couple of days. It became pop news that quickly faded. Once we got beyond that, the discretionary sector was the best performing sector in 2024 going into the end of the year. Are we going to see something similar to that as we finish out 2025? Pure speculation, but it did happen a year ago. We'll see if something like that develops for 2025. Large cap growth off of the highs here. Still above the moving averages, looking positive overall, but not really breaking out to the upside, at least yet. And then we look at the longer term moving averages. The 150, it's actually a little bit above 350 here. Nothing magical about that. It's just when we get above this red line at 350, that's when it starts to get extreme. Now, it's positive in and of itself. That's why it's on the positive side. But sometimes when we get a little bit far away here, that can produce more of a longer term pullback. We're still well below the red line, kind of going sideways right now with the 200 period simple moving average. And we look at those stocks inside of the S&P, still above 50. When we look at the 20 period moving average study, we have been trailing off a little bit as the S&P has been going up. That's a bit of a negative divergence longer term, but this is a short-term indicator, so it could improve relatively quickly if we continue to go up. Also, looking okay here, a little bit of a negative divergence with the 50 period moving average study. We've been going up with the S&P. This is not going up with it as well. We're looking a little better here, not really seeing much of a negative divergence with the 100 period moving average study. And even with the down day, we still went up with this indicator in Friday's session. Pretty much flat and still seeing a series of higher highs here with the 200 period moving average study. So shorter term looking a little bit vulnerable, longer term still looking more solid. Now to me, and I've been saying this too, this is probably the most important chart right now. This is a weekly chart of the S&P. We've been dealing with this R1 pivot point for 3 weeks now. We came up to it. We were not able to close above it. We got above it briefly, but we weren't able to close above it by Friday's close. We got above it this week too, but then we ended up closing down just a little bit below. This is overhead resistance until it's proven otherwise. And this level is at 64.68. We closed at 64.60. We're just 8 points below it. But the market knows that. And the algorithms out there that trade automatically, all the computers, they know that too. And is this going to present some kind of a problem? Because we've dealt with this for 3 weeks now. Now, on the positive side, we're still here. Okay, so we could still break above it. Just because we're at resistance doesn't mean we're going to turn and go the other way. Also on the positive side, a lot of times, if you look at these other pivot points before, we tended to not stay at them for very long when there was a reversal. Well, we've been up here for 3 weeks now. That's quite a long time for this chart. So that could be considered positive as well. But it has to be treated, even though it's positive, it has to be treated with suspicion until we see evidence, not just on Monday or Tuesday or Thursday, but by Friday, because we were above this on Thursday. We fell down below it on Friday. It's going to come into Friday's close. If we're above the 64.68 level, that's when we're finally breaking above this resistance level. Okay, and we're also coming up to the upper end of this trend channel, going back to 2009. That could be producing some overhead resistance as well. Now, this is positive. This is the daily special K chart. We're above the red line here, even though the red line's declining. We don't get a lot of signals with this chart. We didn't get any in 2024. And so far, we've had 2 in 2025. That's why I don't show this in the daily video. And then we look at a 10-day moving average of the highs and lows for the S&P. Above the green line, showing a nice solid reading. That is longer term positive. And we're above the moving averages here with all the different indexes that we look at for the advanced decline line studies. And even though we declined, we're still above zero with the NYSE McClellan oscillator. Now, when we get to the negative side, we're slightly below zero with the S&P 500. But we're still slightly positive here. But you could say, okay, as we've been going up here, we're seeing a series of lower highs. That's a negative divergence, something to be aware of, but we're still positive when you look at the reading all by itself since we're above zero. So when that's above zero, we're going up with the summation index based on price as well as volume for the NYSE. And this is another broad market measure, a 5-period moving average of the highs and lows across the Amex, NASDAQ, and NYSE. We're above zero and continuing to advance. We're off the highs here, but this is still looking positive, and that's also longer term. And we saw an improvement here. Now, this is not positive or negative if you just look at the number. We're at zero. But when we really went down last spring, we ended up coming all the way down to a -10. As we were coming up out of those lows, we got up to a -6. And then this is after Thursday. You notice up here, this is August 28th. This is 1 day behind. We actually increased this up to a 0. So I'm taking this as positive since we're coming off of a more negative reading. Then we look at some other indexes outside of the S&P. The Dow just kind of chopping along sideways, but still looking positive, also in an uptrend off of recent all-time highs. The Nasdaq also dealing with a pivot point here that has been providing overhead resistance. If we come down, I know it's hard to see because we have the new pivot points for September here, but will this end up providing support? It provided support here back in August, and we were able to launch up off of that. It also provided resistance back in August, and then we came all the way back down to support. Now we're all the way back up to resistance. You can see we're kind of bouncing around like bumper cars. Yes, these pivot points, especially for the NASDAQ and NASDAQ 100, are quite important. Here's the NASDAQ 100. We got a little bit above this pivot point, came back down, went a little bit below. Now we came right about back up to this pivot point, and we came down in Friday's session. Is this pivot point for September going to hold as support? Small caps, recent golden cross. We waited quite a while for that to happen with the S&P 600, where we already saw a golden cross with the Russell 2000 small cap index. That happened at the beginning of August. Then the S&P 1600 was right at the end, near the end of August anyway. So the small caps are really improving right now. They like a lower interest rate environment. Mid caps also tending to be more positive than negative, not really breaking out, but holding up fairly well. And then we did set a new high here with the Wilshire 5000, but then we dropped down on Friday. We also set a new high with the total US stock ETF and then dropped down on Friday. Financial sector really improving by itself here. We're setting all-time highs with the financial sector. So you look at just this chart, yeah, that's pretty positive. What's been a concern is if you go back to about May, it's been really underperforming the S&P when we do a ratio of the financial sector to the S&P. Now it's coming back up. Now, if this can continue to go up, yeah, that's going to be quite positive for the market. But we finally got back above the 50-day moving average. Let's see if we can get back above the 200-day moving average with this ratio. Then we look at the FANG index, which did set an all-time high on Thursday, but then had a decline on Friday, but still above its 50-day moving average, still in an uptrend. These are the really big stocks. Then we look at some ratios between stocks and bonds. We're still above the rainbow. Even though we haven't really been breaking out, we're still above all of these lines here. And this means that the market is anticipating a soft landing, meaning no recession. And we look at a number of different ones. This is that same ratio, but inverted. This is bonds to stocks instead of stocks to bonds, still showing how bonds are underperforming. Let me look at the S&P 1500 with short-term bonds, looking pretty good, above the rainbow. A broad market measure with 3 to 7 year bonds, still above the rainbow. The Qs, the 3 to 7 year bonds, a little bit of weakness here. This is part of this shorter term vulnerability that we're seeing with growth starting to underperform value a little bit. Shorter term, not in the longer term, but more in the short term, as the market may be getting a little bit more defensive as we head into September. So this is still positive, but you can see how it's been trailing behind some of the charts that I showed before this. And also coming down a little bit with the tech sector to 3 to 7 year bonds. We want to see this above the rainbow and going up to be more positive. Home construction still improving. Coming back, it cleared all the way back through this rainbow. Not really breaking out right now, but it's maintaining the gains that we've been seeing with this ratio. And the weekly chart of the NASDAQ 100, we're still above this trend line going back to 2009. Then the NASDAQ 100 to Dow ratio, this is a growth to value ratio. Took a bit of a hit here in Friday's session, but we're still above this red line. Then the Qs to small caps. Now, small caps had a good day on Friday, and the Qs had a bad day. So that's why this ratio came down, but we're still above this blue line with the ratio overall. Semiconductors off of their highs, but still above their 50-day moving average. SMH semiconductors still above their 50-day moving average, but not at all-time highs right now. Coming back down into the top end of the rainbow with the SMH ETF. Then semiconductors to Dow, growth to value, just kind of going sideways recently, but really improved with this ratio going up. But we're not quite back up to the blue line. We're coming down just a little bit. We'll be watching this to see if there's any weakness coming in. Then the negative side here, we barely were down. We were down 0.1% for the week. Had we closed on Thursday, which a lot of people seem to think we did because volume was so light on Friday, we would have had an up week. But we really came down here overall when you look at the week. And then this is also the pivot points for the upcoming Tuesday that we'll see for September 2nd. Now, this is where we saw a little bit of weakness. We've been improving here with the intraday growth to value chart, 15-minute chart here. It's more positive when the blue line's above the red line. Now, it's also positive if both the red line and the blue line are going up. Well, growth took a hit here. Was that profit taking, or is this more of a shift to a defensive nature? Because you can see the red line went up or was virtually unchanged, where we had a pretty significant decline with the blue line, which is growth. And we were improving with the intraday growth to value ratio here for the S&P, but then it got smacked pretty hard in Friday's session. Is this going to be buy the dippers coming back in on Tuesday and thinking that they're getting some good prices? Or is this the beginning of something that the market is getting more defensive? That's the question that we're asking. And we're seeing a bit of a breakdown here with the small cap growth to value end of day chart below the 200-day moving average, below the 50-day moving average with mid cap growth to value, and below the 50-day moving average with S&P growth to value. Longer term, positive here. We're still in an uptrend, but we're seeing more shorter term weakness. And this was developing as we were coming out through August, and it was trying to improve, but we haven't reclaimed the 50-day moving average yet. Then we look at a growth to value ETF coming back a little bit deeper into the rainbow here. Positive, but looking a little more defensive. And then our growth to value ratios, the Qs to S&P down below a declining moving average. That's why this chart is negative. We're also negative because large cap growth is under the moving average when compared to large cap value. Now we're holding up here with discretionary to the S&P. That's been a stronger area. It got hit on Friday, but we're still above an advancing moving average. And so we're below the moving average with the large caps, mid caps, and small caps. So this is just showing a little bit more of a defensive posture coming into the market. And we saw a bit of a bounce up here with the value to tech ratio. When this ratio is going down, that's more positive. It's been coming back up a little bit deeper into the rainbow. So just something to be aware of there. Then this is the S&P McClellan oscillator. We're just slightly below zero. And you can see not a lot of conviction. We're also seeing where we were going up with the S&P, setting lower highs here with the McClellan oscillator itself. That could be interpreted as a negative divergence. But we saw that here back in May, and we set a lower high here, but then the S&P just kept going up. So we want to be aware of these negative divergences, but just kind of know that they exist. And then we wait to see if we see a follow through with price. We didn't see that, at least yet. We're wondering if it's going to be different as we get into September. So we're kind of flatlining to slightly down here based on price with the summation index. We are declining here based on volume. Swindle trading oscillator declining based on price and volume. That's negative. And we're still seeing some really lethargic momentum oscillators here. The PMO continues to decline below the moving average. But then when we break it out based on price, we're flat. But we're still below the moving average here based on volume. That could be a little bit more negative when volume tends to lead price. We did decline, but we're still above 50 with the PMOs that are rising, rolling over a bit with the buy signals, but still above 50. We're continuing to go up here with the PMOs inside the S&P that are above zero. And this is where we're seeing more of this lethargic movement here. We were actually turning positive with the slope oscillator, but that was a negative divergence because our other short-term oscillator, the TSI, was still going down, and now it's going down again. Now this is rolling over a little bit here. And we're pretty much flatlined to slightly negative here with the 3 intermediate term oscillators, and we continue to be negative with our 2 long-term oscillators. And we're starting to turn over negative where we had been positive with the Copic curve. This is another momentum oscillator. Now, the reason why we're negative here is we drop below the moving average with the bullish percent index for the S&P. This had been actually doing quite well, and even when we would have down days, quite often the bullish percent index for the S&P would continue to go up. Well, it got hit a bit in Friday's session, enough to drop down here, so we have to classify that more as negative. But then when you look at the NYSE bullish percent index, it declined a little bit as well, but it's been going up. I don't put a moving average on here. Really, if we're above 50 and for the most part going up, that's considered positive. Now, one thing that was a little bit encouraging, though, is the NASDAQ 100 bullish percent index, which had been hanging out a little bit above and below 50. That's the line between positive and negative. We actually saw a little bit of an advance in Friday's session, even though we were down for the session. But we still continue to drop off, and we've been seeing this since really the latter part of May, where the momentum for the NASDAQ 100 continues to decline as the NASDAQ 100 has been going up. We see little pockets of improvement here, but nothing that is showing much conviction. The Qs, they were positive until Friday. They closed down back below their 20-period moving average. Now, the areas that we're just watching, we want to keep an eye on weekly jobless claims, which this is part of why the market went up on Thursday, because we're still within a pretty defined range that we're not really seeing them really shoot up. We're not seeing them really break down either. The moving average is still going up, but we did see a decline in the latest reading. Where the market's a little bit more concerned is with continuing claims. They're staying stubbornly high here, still below the 2 million mark, but they're not really coming down. But they did decline a little bit in with the latest reading here, but the moving average also is still going up. And then the skew index, and this is in the watching area because we don't really know if the market's anticipating an up or down move because of this. You can make a case for each. That's why I put the arrows on here. It's just that this is calculated using out of the money options. They could be calls if there's a lot of calls thinking that the market's going to go up. It could be a lot of puts that people are buying if they think the market's going to be going down. And it's kind of hard to really know that beforehand, but we are still up in this red area, but we've been up in this red area for a while. We drop down and then we go right back up into it. So the market is still anticipating some kind of a big move. And we want to keep an eye on the staples to tech ratio. This had been coming down, but then it started to go back up. Then it really fell on Thursday. Then it came back up on Friday. Because it's so schizo right now, I put it over in the watching column. If we were seeing more of a decline, this would be on the positive side. And we're doing okay here, but we just keep an eye on the 10-year yield. We're well below the 4.5%. We've been drifting lower. That tends to be positive overall, but we just watch this. And then we're still looking pretty good here. This is the spread between risky and not as risky bonds. When this is going up, that means fear is decreasing, and that is more positive. And we're tending to drop off here with the 3-month yield, which lower interest rates, stocks tend to like that, whether it's long-term rates or shorter-term rates. And then we look at the relationship between different maturities of bonds to see, okay, instead of watching a YouTube video or reading a blog where somebody makes a dogmatic declaration that interest rates are going to go up or down, I try to use these next set of charts to say, what's the market telling us? Because that's really all that matters. And when this ratio is going down like it is right now, that means that cash is underperforming 3 to 7-year bonds. When the market is more uncertain and interest rates are going up and they're afraid of that, we see this ratio really going up. Well, now it's going down. So that is more positive. Not really seeing much of a change here. When we look at TIPS, Treasury inflation protected securities, these outperform when the market's worried about inflation and interest rates. Well, we came down in Friday's session and we've just been going along sideways. We did get up to a little higher range here, but we're not really seeing an awful lot of conviction here. And we're not seeing an awful lot of conviction here with tips to further out 7 to 10-year bonds. Then we look at the S&P to utilities ratio. You could say this is positive because utilities were down and the S&P was down too, but we haven't seen a lot of conviction with this overall ratio. It was improving, then it came back down. Now it's starting to go back up. We're just watching this overall. And then also the staples to S&P ratio came down. That was really positive after Thursday, but then it bounced back up. We'll see. If the market's getting more defensive, then this ratio would continue to be going up. If we're getting more offensive or growth oriented, this ratio would continue to go down. And then we saw small caps have a good day on Friday where the large caps did not. And so we're kind of breaking out of this range. This is a ratio between large caps and small caps. When this is going up, that means large caps are outperforming. When this is going down, that means small caps are outperforming. Still really too early to tell if there's any conviction behind this, but we are seeing a bit of a change here. And then semis to tech. We were showing an improvement, then we really came down in Friday's session. Okay, then we were seeing some weakness, then we saw some strength. It's on the watch side because we're not really getting a lot of extended conviction with this chart either. Then kind of a similar thing here with high beta to low beta. We were breaking out on Thursday, then we came back down on Friday after being kind of range bound. Now overall, this has been improving and we're still getting a nice reading with this, but not a lot of conviction here in the shorter term. We want to keep an eye on retail, where it had been underperforming the S&P. It's still leveling out here, actually putting in kind of a higher low and a little bit of a higher high here. That's when we look at the ratio. And we are in an uptrend when we look at retail by itself. This is a huge part of the economy. And we're looking pretty good there. Even though we declined, we're still above 50 with the RSI. Also, keeping an eye on different ratios here. The discretionary to staples, this is the weighted version. This has been improving, even though it got hit on Friday. The equal weight version also improving, but came back on Friday. The tech to utilities, growth versus value, still kind of range bound and going sideways here. Biotech, which is growth, to healthcare, which is value, kind of going sideways, but seeing a bit of an improvement when we compare hotels to utilities. This has been improving overall. Discretionary to what's considered to be more defensive utilities. And we want to keep an eye on the bellwethers. Semiconductors still doing okay, but got hit on Friday. We saw a lot of that. Home builders improving, kind of drifting a little bit down here, going sideways with the transports. We were improving with retail, but it got hit on Friday. And general improvement overall with the regional banks as well. And then we keep an eye on the gold to stock ratio, the gold to SPY ratio here. Gold could possibly be breaking out right now. It kind of got to the higher end and above the recent range that it's been in. That's why we saw a little bit of an uptick here. But in the bigger picture, this ratio has been coming down, meaning the gold's been underperforming the S&P. And US versus international stocks kind of drifting higher, but now starting to go sideways, where it had been really weaker earlier on in 2025. Kind of drifting down a little bit with momentum stocks, where these held up better when stocks were really going down. They've started to underperform as stocks were going back up with this ratio to the S&P, and still going sideways with emerging markets to developed markets. Not seeing any real conviction there. We want to keep an eye on oil. It's still in a downtrend, but it's been hanging around the mid 60s for right now. And the dollar continues to be in a downtrend, both on the daily chart here and then on the weekly chart. It's also in a downtrend. This is what's been helping stocks to go up. Stocks like a weaker dollar. And then the German DAX, not really breaking out right now, but holding out around its 50-day moving average. Seeing a general overall improvement when we compare US stocks to German stocks, which are really EU stocks because the German market is the biggest market in the EU. So this has been improving overall, but it took a big hit earlier in 2025. So thank you. I hope you're having a really good Labor Day weekend, and I will talk to you in the next video.